Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. This is a P&L statement of a prominent mid-cap company. Apologies for the small fonts as I had to fit the data in one slide. Anyways, please focus on the performance of the company for the 10 years between FY13 and FY23. It does look impressive, isn't it? The top line between FY13 and FY23 has gone up by almost 6 times. The bottom line or the net profits have also gone up by a similar magnitude 6 times. So the top line as well as the bottom line has gone up by 6 times, which translates into a CAGR of 20%, which is quite good in my view. Now let us talk about the share price performance of this company. You see, over the last 10 years, the stock market has given this company a P multiple of 18 times on average. Now please note I'm talking about the average P multiple. So there have been occasions where the P multiple has gone up to as high as 35 times, and there have been occasions where it had gone to as low as 12 times. On average though, the multiple has stood at around 18 times. If you would have noticed the first slide, the earnings per share or the EPS of the company in FY23 was around rupees 50 per share. It was the same in FY22 also. The math is therefore simple. Earnings per share of rupees 50 multiplied by P multiple of 18 times gives you a fair value of around rupees 900 per share. Now this means that based on historical average P multiple and the company's earnings power, a rational investor would buy the company at rupees 900 per share or lower. Now assuming that the company is able to grow its earnings by 15% as opposed to the 20% historically, and the buying price of the investor of rupees 900 per share, he can hold the stock for 3 to 5 years, earn his returns of 15% to 20% per annum, and then exit if he wants to. He can sell the stock at the same multiple of 18 times if the fundamentals of the company remain intact. Here's the surprise though. This stock is currently trading in the market at just rupees 500 per share. Yes, that's correct. Mr. Market is not valuing the stock at rupees 900 per share, but is valuing it at a much lower price of rupees 500 per share. Now there are a couple of reasons on why Mr. Market is devaluing the stock so much. The first reason is the performance of the company in the last 12 months. The performance is disappointing to say the least. As you can see, the company has incurred a loss of rupees 718 crores in the 12 months ending December 2023. Now this loss has occurred because of one of the worst slowdowns the industry is facing in decades. The company is hurt not only on the top line front, where both volumes as well as realizations are down, the profitability has also taken a hit due to increase in rebates and sizable revaluation of inventory. Hence, from a consistent 18% to 20%, the operating margin has fallen to 11% during the trailing 12 months. And this is one of the main reasons why the stock is trading at just rupees 500 per share, as the losses have spooked investors. Now there's another reason why investors seem to be worried, and it is to be found on the balance sheet of the company. There are two things that stand out when you look at the balance sheet of this stock. First, the debt to equity ratio has been well under control till FY18. It has remained below 1 times between FY12 and FY18. The second thing is that the debt to equity ratio has shot up suddenly in FY19 from 6,600 crores to a whopping 29,139 crores. That's a jump of almost 4.5 times. Now what explains this huge jump in the debt levels of the company? Well, the company did a leveraged acquisition in FY19 worth around 30,000 crores. Yes, that's correct. It paid close to rupees 30,000 crores to buy a company called as Arista Life Science to deepen its global footprint. And around 70% of this acquisition was done through debt. In other words, the company had to take on debt of more than 20,000 crores in order to generate funds for the acquisition. And it is this debt that has remained on the company's balance sheet since then. In fact, the total debt has gone up marginally from 29,000 crores in FY19 to around 35,000 currently, as you saw on the slide. Now, to be fair to the company, while the overall debt levels have gone up, the debt to equity ratio has come down from 2 times in FY19 to 1.4 in September 23. So the effort towards deleveraging is certainly being seen. Of course, it must speed up more in my view. Now, as we just saw, a rational investor would pay rupees 900 for this stock, but because of the huge losses in the last 12 months and also the high leverage, the company is currently trading at rupees 500 per share. The million-dollar question, therefore, is whether the company would return to its old profitability and growth, and if yes, how soon? Also, will leverage be further brought under control? Now, I have read a little bit on the company, and here's what I found. The management expects to return to mid-single digit growth in revenues and profits in FY25, and from FY26 onwards, it expects to get back to its old growth of 15% to 20%. So yes, the company will start growing again by FY26 if you believe the management. Besides, the company's debt levels are also expected to come down on account of initiatives like receivables factoring and stretching of creditors. It is also proposing to raise equity worth rupees 4,000 crores by way of rights issue in order to further reduce debt. Now, these are all positive signs indeed. Not only is the profitability and growth expected to return by FY26, the debt levels are also expected to go down. In other words, if things go as per the planning of the management and if Mr. Market again values the company at the same P multiple as it has done in the past, there is a strong chance for the stock price to touch rupees 900 or so levels again. Now, of course, this is not an advice to buy the stock. I'm just highlighting one of the many scenarios possible, and you are advised to do your own research. I'm sure you're wondering, why have I not revealed the name of the stock yet? Well, if you haven't guessed by now, the stock is none other than UPL Limited, which is amongst the top 5 agrochemical companies in the world. Let me repeat that. The stock is none other than UPL Limited. Some of you may find my analysis shallow and not up to the mark. You may wonder, where is the analysis of the company's different products and the market share? Where is the industry analysis? And also, why is there no mention about the management and the future prospects of UPL? Well, I'd like to point out that whatever qualitative information I needed on the company, I have found most of it in the historical financials of the company. You can make out from the historical financials that the company seems to be doing a good job of growing both volumes as well as realizations. You can't grow at 20% per annum by growing volumes or realizations alone. Both need to contribute. I'm also impressed by the consistency in operating profit margins, which tells me about good control on costs as well as decent pricing power. Yes, it did make a dubious decision by going in for a leverage buyout, which led to its debt levels exploding. However, it seems to be working hard to bring debt under control. As to the future prospects, I'm not expecting something extraordinary from the company. All I'm expecting is for it to return to its old growth trajectory of 15% to 20%, which it is capable of achieving, as it has managed to do the same in the past. Yes, if I was expecting the company to grow at 25%, 30%, then it's a different story. But I do believe it has the systems and processes in place to grow at its historical growth rate of 15% to 20%. I believe this much qualitative understanding is enough if the company has a long history and if the valuations are reasonable. This much understanding is enough to minimize losses if things don't go as per plan or a turnaround is taking longer than usual. Lastly, you also have portfolio diversification, where you have a portfolio of 20 to 30 stocks, so that even if a few stocks don't work out, you would still be fine because your portfolio is spread across a large number of stocks. Therefore, in conclusion, the risk-reward equation in UPL appears quite decent from a rational investment perspective provided the company returns to its old growth and profitability and the stock market rewards it with its old P multiple of 18 times. Let me know what you think. This brings me to the end of this video. I'll see you again in the next session. Goodbye and happy investing.